To remain updated with the latest business news, click on the bell icon.
Although monetary policy was in accommodative mode, financial markets were volatile amidst considerable uncertainty about the future course of monetary policy. In particular, markets were anticipating more tightening of US monetary policy than projected by the Fed at that time, and this was the factor that caused larger than expected spillovers. In emerging market economies, these spillovers interacted with underlying vulnerabilities, triggering capital outflows and a significant tightening of financial conditions in some of them, especially among the fragile five. As events unfolded, however, markets were found to be racing ahead of the real economy. The Fed decided not to begin tapering in September, which resulted in a modest easing of yields. Circling back to 2022, the global recovery is once again on a weak wicket, edgy and prone to miss hits. The Omicron wave has taken its toll, and there is growing evidence of loss of pace in the first quarter of 2022, as I alluded to earlier. As in 2013, the paths of advanced and emerging economies are diverging today, with advanced economies expected to cross pre-pandemic levels, while emerging markets lag behind. As financial markets are highly volatile now, as they were in that fateful summer of 2013, uncertainty grows the world over. War has added a whole new dimension to the outlook, and in fact, a weighty downside. With regard to other macroeconomic and financial conditions, however, 2022 and 2013 are studies in contrast. Today, advanced economies are struggling with inflation at multi-decadal highs this year. In several emerging markets too, inflation is way above targets, prompting them to be first movers in raising policy rates, with advanced economies following this time around. In terms of financial conditions, it is sobering to keep in mind that the US taper of 2013 involved winding down a US $85 billion monthly purchase program in a span of 10 months in 2014. In contrast, a US $120 billion monthly purchase program is being wound down in 4 months by March 2022. Before the commencement of the 2014 taper, the Fed had expanded its balance sheet by around 3.1 trillion US dollars over a period of 64 months. In response to the pandemic, the Fed's balance sheet has expanded by $3.1 trillion in 9 months, just 9 months between March to November 2020. It has expanded another 3.1 trillion in the ensuing 11 months up to October 2021, and it continues to expand as asset purchases are scheduled to end only in March. Then there is an elephant in the room in 2022, which is making the biggest intertemporal difference. Financial markets reacted to the first missiles and airstrikes on February 25th with a bloodbath across the world. Equity and currency markets tanked, and stampedes to safety lifted the prices of US treasuries, gold, the US dollar, as also some safe house currencies like the Japanese yen. Now, these are externalities of spillovers which we have seen before. In fact, equity markets recovered towards the close of trading on the same day and through the next two, although they sank again with fresh sanctions, including swift exclusion, which was announced on February 27th. Then there are some spillovers which we have not seen before. Commodity prices are surging in a synchronized manner. Energy prices in particular are shattering what were widely regarded as glass ceilings. International crude prices crossed $100 for the first time since 2014. With new rounds of sanctions, US dollar 125 to 150 will be tested. Natural gas futures have surged 50 to 70% in Europe and are still looking northwards. Benchmark prices of nickel, copper, aluminum, and palladium are at the highest levels in a decade. Wheat and corn futures are at multi-year highs. The world is also bracing up for higher fertilizer prices and restrictions on energy supplies. Although the situation today is significantly different from the oil shocks of the 1970s, energy markets are global and price waves find their way across the world. They have the potential to sap household spending, and the risk of a recession could intensify. Let me spend a few minutes on domestic macro fundamentals. In a dynamic international environment fraught with high uncertainty and elevated perceptions of risk, it is ultimately the strength and resilience of the macroeconomic fundamentals that will determine our ability to manage external shocks. And it is useful in this context to draw lessons from the 2013 experience. Recall that in 2009, India was among the first nations to bounce out of the global financial crisis on the wings of fiscal and monetary stimulus. Aspirations about India's underlying potential seemed within reach. History would, however, ordain otherwise. With the gradual unwinding of the fiscal stimulus in India, the economy lost steam. This was accompanied by a persistent deceleration in the investment rate led by the private corporate sector. Also, there was a slowing down of bank credit and a widening of external imbalances to which I will revert shortly. Over the period 2011 to 14, however, private consumption remained strong and the mainstay of growth in India. Let me cut to the present. Ahead of the pandemic, a cyclical downturn had taken the growth of the economy in 2019-20 to its lowest rate since the global financial crisis. But even this nadir has become a reference point for evaluating the recovery from the pandemic. At the height of the first wave of infections, India plunged into one of the deepest recessions in the world, with GDP declining by as much as 23.8% in the first quarter of 2021. A gradual recovery took hold during the second half of the year, only to be interrupted by the second wave. During the whole year, the Indian economy contracted by 6.6%. The brunt of the second wave was actually felt in the first quarter of 21-22. Camouflaged by statistical base effects, the level of GDP fell 8.3% below pre-pandemic levels, that is 1920 levels, in 21-22, the whole year. While the third wave that began in late December has had a relatively milder effect, as reflected in high-frequency indicators, GDP is expected to rise only 1.8% above pre-pandemic levels in the full year 21-22. The important difference is that private consumption is just a shade above its pre-pandemic level, with discretionary consumption spending still lacking traction. Private investment is yet to participate in the recovery.
If you like the video, do like, comment, share and subscribe.